we're going to be talking about a very unusual day, a rotational day that takes place within balance or within the range for the previous session. Let's go and look at the next slide. What is going to be unusual about this is the different characteristics when a day opens within the previous day's range and remains within that range for the entire day. You are looking at the behavior of short-term traders. Longer-term, short-term traders or investment money is generally not involved to any meaningful extent on these days. So they're very important, and it's not often that we get a chance to isolate a day by itself. And that is going to be very helpful for you to see what happens. Now, as you go forward in your learning, behavior of very short-term traders, and from time to time, you'll get the entry of longer-term, short-term traders and investment money. This is a pure, unadulterated day. The day we are looking at is taking place on July 5th. It's a holiday week, it's during the summer, and it's following the July 4th holiday. And it's an unusual day also because it is the release of the monthly employment report. The monthly employment report, in my opinion, has very little long-term significance. The reason for that is the investment money looks at the weekly reports and they just keep building a bank of weeklies. The monthly report is more of a report that gets hyped by the media, and short-term traders get all excited about it being, this wonderful, great big news day. In reality, it's not, but it is usually attracts volatility. I had tweeted over the weekend that the 5th, the day that we are starting with, broke hard in the morning, and then you had a late rebound. My tweet, which was carried on the a large tweet session for all to see, said that the rebound or the recovery rebound on Friday afternoon lacked supporting structure. So when I make a comment like this, it is to reflect that, in my opinion, the odds of upward continuation are low. That doesn't mean it won't happen, but the odds of upward continuation are low, and I think the odds are higher that we will retrace part of the late break from, or the late rally from Friday. So now let's move forward and let's take a look at the important considerations as we get ready to trade on Monday morning. As we come in on Monday morning, the first thing we notice is that overnight trade is short. You can see the overnight trade high, you can see the settle from Friday, and you can see that the predominance of overnight activity took place below the settle from Friday. When overnight inventory is short, the odds are, and we'd estimate this to be about 65% of the time, that you will get a counter auction. A counter auction means a correction relative to overnight inventory being short. So a counter auction relative to overnight inventory being short would be an early rally. If we get that early rally, then you have to observe if there's anything more than just short covering. Short covering we label as old business. Usually to take a market substantially higher, you need a combination of old business and new business. So short covering as well as new money entering the market. We also say when we're talking about overnight inventory that one of the most misleading factors for traders is being caught when overnight inventory is simply a correction and nothing more. In other words, if the day we're looking at, we get a short covering rally, the error comes in when traders mistake that price advance that is related to mainly short covering, and they interpret that as being more meaningful. It gets you caught on the wrong side of the market. Also is important, which you'll see in many of the other sessions that you go through as part of the course, is that markets always have to take care of current business first. So if overnight inventory is short, then the current business would be the correct or a counter auction relative to overnight inventory. As we prepare for this day, let's take a look at the other considerations that I think are so important. The first one you're going to see on the next slide is the early focus. Early focus, of course, as we've already discussed, is on overnight inventory. When we see where overnight inventory is going to open, that is also synonymous with where over the last trade and overnight before we go to the day time frame, we can see that we are going to open within the previous day's range. Opening within the previous day's range is an indication that the market is within balance. When a market is within balance, the expectation is that you're going to get a rotational day. In a rotational day, you still need to pay attention to developing value. As you're going to see as we go through the trading for Monday, that value was building lower relative to Friday the 5th. Value is always important. It's not everything, but it certainly is important. Value helps you sift out what is really important in the market. As we get ready to play the day, I want you to pay particular attention to mechanical references. This falls under the label of learning to observe what is going on in the marketplace. Too many times people see the prices moving, but they're not correctly observing what the message is by that price rotation. The references convey a tremendous amount of information. That reference may be the overnight high, it may be the overnight low, it may be the opening, it may be the prominent point of control from overnight. But what happens at those references is very important. Also, the references, what happens there, you need to carry that information forward throughout the session. What happens to us many times, we see that there is either strength or weakness surrounding a reference, but we want to act on it immediately. We lose the ability many times, or we forget about it as the day goes on, to make sure that we can carry that information forward. In the example we're going to talk about, we're going to see the importance of early references playing a very important part is what happens later in the day. Additionally, as we go through this, we are going to be able to focus on the behavioral characteristics of the short-term trader. Remember what we said as we began, it's not often that we get a purity such as we have on Monday. This is only very short-term traders. That doesn't mean there's not, a minor trade by somebody else, but generally it's all short-term traders. So it allows us to isolate those characteristics. As we get ready to play, and we're going to do shortly, we will still focus on the continuous two-way auction process and the ranges. When you have an inside day relative to the continuous two-way auction process, your ranges will generally be much shorter. And the reason for that is that the bids and offers can be totally filled by narrower ranges. When you have a trend day, for example, the ranges will be much broader because it takes substantial more bidding and offering in order to meet the demand of all the orders coming into the market from the longer term time frames. All right, let's go ahead. Let's play. Let's see this day open. We're going to play it. We're going to start playing at 3 times the normal speed. So remember, we have overnight inventory that is short. When overnight inventory is short, the odds are that we will get a counter auction. In this day, we also have a very prominent point of control from overnight. The more prominent a point of control is, the greater the odds that point of control will be revisited. So we're opening this morning and we're within the overnight range, which also makes us within the range from the previous Friday, which was the employment session. All right, so we're opening this morning within the overnight range. We're looking, the first reference we'll be looking at, of course, is the overnight low. And that's what the market's trying to do. Remember, we're at 3 times the normal speed. Characteristics would be that short-term traders would be focusing on the overnight low because it's an easy visual reference for them to see. Once the market trades below the overnight low, they know there's stops there, they take those stops out. Now the market has returned back into the overnight range. Now the question becomes, can the market get any real upward movement? Overnight inventory is short. So far, we have not had a correction to overnight inventory. We have looked below the overnight low a couple of times. We've coming right back up to it. You can see the reference. See how the market's using that overnight low as a short-term reference. The next reference they would be using, if they can get above the overnight low, then the market would set its sights on the opening. Okay, so we're still within Friday's range. We are in and out of the overnight range. Overnight range is short. So we've looked below the overnight low a couple of times. No real follow through. You can see the market is still pushing down again below the overnight low. So trying to push one more time. It's back into the overnight range. This is the 3rd or 4th time. Once it does that, of course, then the upside reference would be the opening, which is the green dot. So right now we're just a few minutes into the day. It's a very narrow range, and it's all contained within Friday's range. Okay, let's move it up to about 5 times the normal speed. So take a look at Friday's value area. You can see that early on, the market has traded slightly into Friday's value area and so far has been rejected. And the question is, can the market really get any downside follow through? So at this point in time, overnight inventory is short. The market is trading lower relative to overnight inventory. And of course, we're back and forth between the overnight low. The next downside reference, of course, would be Friday's low. See Friday's low down there at the 29.71 0.25 level. When a market opens within a previous day's range, I expect chop. Chop means a lot of rotation, and I will generally stay away from trading early on when we have an inside day. And the reason I stay away from that, there's usually too much chop, too easy to get hurt early on. One of the problems that a lot of short-term traders have is that they're too anxious to trade. They come in and they're so concerned that they're going to miss the best trade of the day or the best trade of the week, and it's very easy. It's very easy to lose a lot of both financial capital and psychological capital early on. As you know, you've heard me several times talk about the market being in and out of the overnight range. I think it's 3 or 4 times. The market just rallied up to the overnight low, and the traders sold it off again, taking it down to the early morning low. Remember, we are still within Friday's range. So it still is an inside day. Inside day, the odds are that we're going to get a rotational day. The exceptions occur when the market single prints out of the previous day's range. So we have a lot of single prints today. But the first thing to notice, which I've mentioned several times, we have been in and out of the overnight range several times. And the traders have been selling it at that overnight low. Very mechanical, characteristic. And it's really a sign of weak selling versus a sign of strong selling. So again, you've heard me multiple times talking about the many times we've been in and out of the overnight low. Easy to get caught because you're watching this trade continually selling it off, selling the market from the overnight low. It is easy to get caught up in that and get short. Remember, overnight inventory is short. If the market had a lot of confidence, we would trade below the overnight low once, maybe look back briefly, but then the market would continue lower. So one more time, we're back up towards the overnight low. Now, just not that I'm selling trades in here, but I did on this particular day, I did take a trade. I did buy some out of the money calls, not very big, but I did buy some out of the money calls in here with the idea that the market would rally back up to the very prominent point of control from overnight. And the reason being that it's an inside day. The market has tried several times to trade below the overnight low, and there's not been any real follow through. Okay, we are at 5 times normal speed. How much time do we have left in the first half hour?
Less than a minute.
Less than a minute. Okay, so we're almost 30 minutes into the session. It is still an inside day, and we're going to change time periods right now. So we're now into the second period. And let's see what happens. Remember, our upside reference right now is the overnight low. That is our resistance level right now. See it one more time. The market, they sold the market off from a single tick below the overnight low. Again, that must be the 5th time. Very mechanical. So see get the behavior that very short-term traders are selling from very exacting levels. When that happens, that is usually a sign of weak hands traders, characteristic. All right, so we're now back up above that for many times. Like I said, the next upside reference would be the early morning opening. It's very easy to lose your perspective when you see this market sell off on every little rally. Now, finally, in the second half hour, we're back one more time into the overnight range. As I said, then the objective becomes the opening, followed by the overnight prominent point of control at the 2984.50 level. But reflect upon how easily you could have gotten trapped on the short side of this market. Okay? Very, very important. And it's controlling your emotions on a day like this is terribly, terribly difficult, because you saw the market multiple times for almost 30 minutes trade lower every time we got to the overnight low. Okay, now we're trading higher. You see the B period high is a, can we stop for 1 second? The B period high, when I asked to stop it, was a single tick below the opening. Now the B period high is exactly at the opening, which is the green dot. So one more time, what we're seeing, the characteristics of very short-term traders, trading at very exacting references. That's characteristic. They have small size. Larger money does not trade at exacting references. The reason for that, and you'll hear this many times throughout the course, the reason for that is their size is too large. If they tried to execute at exact references, their performance would be terrible. Their size is too big, other people would catch on, and they would have a terrible time getting a good fill. So what the larger money does, they generally scale into and out of their positions. They don't want to give away, in most cases, what prices they're active at. They try and disguise what they're doing. All right, but at this point in time, we are still within Friday's range. The odds are that all we have are very short-term traders. Okay, let's go ahead and play. We're recording now that the B period high is weak and poor. No excess, and weak because it's at an exact level. Poor because there's no excess, weak because of the exactness of the price. So the odds are that the AB high will not last throughout the session. But yet you see traders were selling just as they were selling exactly at the overnight low. They're now selling exactly at the opening. So the market is now coming back. So we said it was odds were low that it would continue there. So it's now taken that out. Look over at developing value. So we are slightly into the value area from Friday. The market is now rallying further. Remember, overnight inventory was short. The odds are when you have short overnight inventory that you will get a short covering rally. With a short covering rally, it is very easy to get misled, thinking that there is something more meaningful there. Okay, at this point in time, we are one tick below now we're exactly at the very prominent point of control from overnight. Okay, let's stop for 1 second. Remember we said earlier, inside day, chances are it's going to be rotational. When we're within the previous day's range and rotational, the odds are greater that we will revisit the very prominent point of control from overnight. That very prominent point of control has been revisited. We are seeing some correction from a short overnight inventory. We are also into Friday's value area. So now we need to watch very closely to see what value is going to be today relative to Friday. All right, let's remember, when it's a correction to overnight inventory, it is very easy to get misled. One of the things you want to record in your mind was that confidence was not high this morning. We're still within Friday's range. Notice how many times we traded below the overnight low. If confidence was really high, we wouldn't have traded below that low multiple times. So confidence is low. We're getting a correction to overnight inventory. We have made the very prominent point of control. Okay, the opening level or the A period high now becomes short-term support. Talking about references, you want to record that the B period high is not particularly strong, and it's not particularly strong because it is just a single tick above a very exacting reference. All right, let's continue to play. Let's move it up to about 7 times. We've been playing it 5 times. We're going to move up to about 7 times. Value is building, overlapping to lower right now, but we are within the value area from Friday. The early morning high will now become short-term support. Notice the market bouncing off of the A period early morning high. Once again, it's a very mechanical reference. The most important things you should have looked at so far. We are inside day relative to Friday. We have seen some correction to overnight inventory. The market has lacked overall confidence relative to the many times we traded below the overnight low and back in. Okay, let's stop for a second. So I mentioned earlier that when the market, after the market had traded below the overnight low several times, I had bought some calls. When the market traded back up to the overnight prominent point of control, I shorted futures against those calls. And I'm not going to go any more with the trade other than just to give you some idea of how I might see a market and what I might do. I did many more things before the day was over relative to that, but I was just showing you what I really wanted to show you was not brag about a trade, but I wanted to show you that overnight inventory was short. We traded multiple times below the overnight low and then sold off, continued to sold off, which was an indication to me that the market was not weak, at least on a very short-term basis, and that the odds of a rally relative to overnight inventory were high. Then I want to see what happens relative to that rally. Remember, it's a continuous two-way auction process. So now we go up and the B period high is actually, in my opinion, it's weak because it is a single tick above a very prominent reference. All right, so we're playing at 7 times normal speed. We're back down below halfway. We're back down one more time towards the overnight low. We have changed time periods. Remember, we're looking at developing value also. Value had a chance to really start to build higher, and it failed. You left a selling tail up there in B period. So the market rallied. Let's stop for a second. The market rallied. We said one of the most difficult and trickiest situation is when a market rallies relative to a correction to overnight inventory. In this case, overnight inventory was short, and you mistake that rally for something more significant. This, when you get a short covering rally relative to overnight trade, it is an indication of old business, which is short covering, not a combination of old business and new business. Had we had a combination of old business and new business, the odds are we would have found acceptance back above the prominent point of control from overnight and started to build higher value. So more than likely, we were looking at short covering, old business, one of the biggest traps in the world. Okay, let's continue to play. Value is now building overlapping to lower, something we always have to pay attention to. So we kept the overnight, the early morning low. The market is challenging the early morning A period low. One more time, we are below the overnight low. So if the market had any real strength, we wouldn't be back down below the overnight low. If the market had any real weakness, we would be outside of Friday's range. We wouldn't be trading continually within Friday's range. Remember early on, I said that what I had tweeted over the weekend was that the rally from Friday, the recovery rally, did not appear to have sufficient sufficient structure in order to carry the market substantially higher on Monday. That doesn't mean it won't, but it just was my observation. So it's important. Let's stop for a second. A lot of times you hear traders talk about, or people tell you that one of the most important things about trading is discipline. Talking about discipline is highly discussed a lot of times. And what exactly does that mean? Some people say that talking about discipline is a waste of time. Let me define what I mean. One of the things I mean about discipline. A couple of the things that you can do that fall into the category of discipline are have a routine and do your homework every day. So the discipline I'm talking about here isn't discipline related to the market while it's open. It's discipline related to preparation. So going back and reviewing Friday after the market's closed, looking at the structure, doing your homework, what was overnight inventory, what was the structure from Friday, getting prepared, writing scenarios that you thought were potential for Monday, that falls in the category of discipline. It's not discipline that's challenged by the market being open and all the other emotions that can go on there. It's discipline of doing your homework, being prepared for the market. That is probably one of the most important things that can lead to your success, getting prepared for each particular day. All right, let's go ahead and play. So we're into the third period of the session. One more time, the market is right around the overnight low, back into the overnight range. You can see half back with the C period high is exactly at half back. Again, that is a very mechanical reference, and the odds are that the market prior to the day being over will come back through that reference. Now it's taken it out by a single tick. It is still considered a weak reference because of its exactness. Okay, so you saw that didn't last. We're back through it. Now the C period high is just a couple of ticks below the opening. So again, when we look at the session, we are still within Friday's range. The market is rotational. All things that we said were good odds on a rotational day, that the market will rotate back and forth. It won't be, in other words, it won't be a directional day. So if you're looking for trades on a day like this, they're generally short-term trades. You know, don't expect home runs out of them. All right, let's speed it up to about 10 times. So again, we are down below the overnight range. The market is testing to the downside, pushing pretty hard. We haven't gotten the A period low out. So the market is looking at mechanically buying as close to the early morning low as they can get. Very characteristics of short-term traders. It's very visual. Markets are, and the more short-term oriented the markets are, the more visual they will be. So the early morning A period low was an early morning reference. The short-term traders bought the market there. One more time, we're back into the overnight range. The market is right exactly one more time at half back. See the market in D period? The traders, they were selling it off exactly at half back. One tick through it, selling it off again. It's a great example of understanding the behavior. These are weak traders. They're selling at very exacting levels. Okay, we're back through it. Don't forget to look at value. Jen, can you point out the value area low from Friday? Right there. See our value today? We are overlapping to lower value relative to Friday. It is always important to keep your eye on value. So value is building, overlapping to lower. The day is rotational. You're getting a good chance to see, the behavior of very short-term traders, very exacting references. And the market is rotational. One more time, the D period high is exactly at the opening, the green dot. A period high was a tick above it. D period high is exactly at the opening price. Not a good reference, very mechanical. The odds are very good we will come back through that level before the day is over. You're understanding the behavior of the traders you are competing against. Now you can trade with them as long as you understand how they use these references. So D period high is still exactly at the opening. Very weak. Now we're through it by a tick. Still weak. Going through it by a tick is still weak. And you see the market right now, it's half, the white line is half back for the session. Okay, so now you want to carry forward that the A period high is a single tick above the opening. B period high is a single tick above and exactly at the A period high. The odds are that before this day is over, we will come back through that level. Now that is very difficult to carry that information forward for the remainder of the session. It can mess you up, it gets you twisted around, but it's important to understand and keep that information out in front of you. If you don't, then it's easy to forget about it and get trapped on the short side of the market. So the market spent a lot of time trying to go lower. Value is overlapping to lower, so the pressure is to the downside. But again, you've got to record that the A period and B period highs are very questionable. Okay, the market is pushing lower. And remember, we're at 10 times normal speed. Let's go up to about 15 times normal speed. We're not, we're going to play the whole day, but I just want you to get a feel for the characteristics of an inside day and the characteristics of the behavior when the market is controlled almost entirely by very short-term emotional traders. So values building overlapping to lower. When you see the mechanical A period high and D period high, even though the market's going lower, the odds are that the market is getting itself caught short. And it's the reason I say that is because the selling was by weak hands. Weak hands traders trade from exact references. So it's very, very likely that the market's getting itself caught short. And now you see the market, trying to go lower. We're at 15 times normal speed. So, we're playing this out fairly quickly. How long before we change time periods again?
Less than a minute.
Okay, so we're going to go in, now we've changed again, we're in F period. So take a look at the market. It's kind of a B-shaped formation. A B-shaped formation is an indication of liquidation. Let's stop for a second. Remember, I said that it was important to look at Friday, and I thought that Friday's rally wasn't supported by good structure. So that would mean that inventory relative to late Friday was more than likely long. So the market, if the market can't follow through from Friday's recovery rally, then the odds are that we're going to get liquidation on Monday. And the B formation is an indication of liquidation rather than an indication of new money selling. Liquidation would be old money. In other words, old business, because people that were long on Friday are now liquidating. If it was a combination of old money, meaning that liquidation, and new money, we more than likely would be well below Friday's low. It's still a rotational day. We are still within Friday's range. This is a particularly important educational day. Not easy to trade, not easy to read, but it's important that you have somebody pointing out to you some of the important characteristics of a day like this, because these are the days, if you don't understand them, can cause you to lose a lot of money in a very choppy market without the market having made any significant move one way or the other. Additionally, you want to always keep your eye on developing value. Value is developing lower. Okay, let's go ahead and continue to play. I believe we're at 15 times. The market has gone down and has taken out the early morning low by a single tick. So that is a weak low. It's a weak low because it is exactly at a one tick below the early morning low. So it is a weak low, being a single tick below the early morning low is an indication that the buying is by very short-term, weaker hands traders. Very visual, trying to buy at very exacting levels. That is a behavioral characteristic of very short-term traders. The shorter the trader, the weaker the hands. The weaker the hands, the more tendency there will be to give up their positions or reverse their positions very quickly. So now, as we go through the session, we don't think the AD period highs have good odds of carrying throughout the session. And we don't think that there's a good chance that the F period low will remain throughout the session. So now somebody says, well, Jim, how do I do this? You don't like the high, you don't like the low. I'm sorry, you don't like the AD high, you don't like the A period low. What am I to do? Well, guess what? You don't have to do anything. When there's questions in the market, you don't have to be involved. All right, so we said it was unlikely that the low would hold. And now that low was taken out, stops were hit, and one more time, they came in to buy the low. So it was a weak low. They finally took it out. As soon as it was taken out by a couple of ticks, they got the stops. That's all they were doing. And now the market has rallied. Look at the white line above. The white line above is half back. Half back is another important day time frame or very short-term reference. A lot of people ask why. The answer is because that's just what the market has decided to do over the years. Okay, so G period is now down testing the F period low. So now we're down to just a couple of ticks of excess. How many times have we been below the overnight low? It's got to be 7 or 8 now. But again, notice value. Value is developing, overlapping to lower in the market. Very important it's a filter. Value provides a filter to say what's really going on. So underneath the surface, value is building, overlapping to lower. A lot of rotation in here. We said inventory was probably long from Friday, but at the same time, we say, well, be careful because the market It's probably getting too short. Look at the the B period high is just a tick above overnight. So it's a tick above a very mechanical reference. The AD period highs are very questionable, both being a tick above the opening. The chances are that this market is getting too short. It doesn't mean it's not going lower, because how does it get too short? Traders continually to sell the market short, continually to sell. Again, notice the B formation. Market is rallying. The G period failed to take out the F period low. H period has come out of the inside bar from G period. The next upper reference, of course, is going to be half back. A very difficult day to trade. Rotational, inside day. We could look at that, and the odds were it's going to remain inside from the opening. If it wasn't going to remain inside from the opening, the chances are we would have single printed out of the previous day's range very early. We didn't do that. When a market is rotational, like this day, you do not have to trade that day. A day like this is going to hurt a lot of short-term traders. They will get whipsawed long, whipsawed short. Tremendous amount of psychological and financial capital is lost on these kind of days unless you understand where they are. I'm not going to be short this day because of the questionable B period high, the questionable AD period highs. Even though, but you say, but Jim, value is building overlapping to lower. And the answer is yes. And you might get a short covering rally late in the day or sometime in the day. And after that short covering rally, I might feel more comfortable on the short side because value's overlapping to lower. But right now, I'm very concerned that this market is getting too short. And look at the formation. Okay, so we're in the I period. We're extending the day. The point of control is developing. We're very important on the point of control on a rotational day. So the I period high, we've talked about it, went to a very mechanical level, half back. We pointed it out before. We said it's a very mechanical level. And what is the market doing? One more time, they sold the market off from exactly half back. One more indication that this market is getting too short. Who sells from exactly half back? That's weak hands traders. Now, if we can stop for 1 second. When we go through our educational courses, we talk about two types of traders. We talk about the fast trader and the slow trader. A fast trader is somebody who's very nimble. They don't think about, they just react to the market. They look at the short-term trade. They would sell immediately at the half back because they know that's a very typical short-term trader's reference. If it goes through it, they're out. Boom. They don't fall in love with the trade. They don't overthink the trade. They are just able to react to those things very quickly. Part of the problem with being a fast trader. Fast trades are almost always going to be counter to the market's most recent reaction. So the most recent reaction, you see the market rally in I period to the overnight, or I'm sorry, to the half back level. And the fast trader is going to sell immediately. So you're selling in the face of the most recent market activity. It looks nice afterwards, but psychologically, that's very hard to do. It is a skill you need to develop. If you have to ask, am I a fast trader or not? You're not a fast trader. Fast traders, they're limited, but they're very quick. Their stimulus response, they don't fall in love with anything. All right, when I look at that as a slow trader, when I look at that weak I period high because of its exactness, I start thinking maybe I want to get long. Now, why am I don't want to get long? I've already said the B period high is questionable to me because one tick above the overnight very prominent point of control. The AD period highs are a single tick above the opening and they match. So that's questionable. I think there's a good chance we come back through that. And the I period high is exactly at half back. Again, good odds that we are going to come back through that. All right, let's continue to play it 15 times. So just recently, we've seen discussion of a fast trader and discussion of a potential slow trade. So the F and G period lows are relatively close together. See what the markets are doing. They're buying the markets exactly as close as they can get to the previous lows. How much time left in I period?
Less than 5 minutes.
Okay. So, and we're talking about, remember we're playing it 15 times, so it's going to be less than that. Okay, let's just watch this play out. This almost, you look at a day like this, it's almost like we cherry picked it when you see the exactness of the I period, but these things do happen. And again, it's just the behavioral characteristics of who is in command today, or at least who thinks they're in command. Okay, so the market I period high is questionable. The J period low is a single tick below the I period low. So now you've got a lot of lows together, the F, G, I, J. Okay, let's speed up to about 20 times. Notice the point of control. The point of control has come down. Initially, it was at half back. You see the gold at the F period. Then you see the gold at the FHI. And now you see the green. So we have had some downward rotation on the point of control. Value overlapping to lower. Okay, now we're down in the area. There's going to be a lot of stops. F low, G low, I low, J period. Okay, so now okay, let's stop for a second. Okay, now this can be tricky. We saw the market mechanically buying as close to the lows as possible. We saw the F, G, I, and J before it broke was just a single tick below I. So we talk a lot about the firecracker effect. The firecracker effect can occur when you have multiple days that are the lows or the highs are very close together. It can also occur when you have the 30-minute bars close together. The firecracker effect occurs when for example, right here, one low triggers the stops, which is enough to trigger stops, select the stops for the next low, which triggers the next low, etc. So now you've got a push down and you got the I, G, F lows, and the market spiked down, and now it's immediately back. So more than likely, what you saw was firecracker effect taking out those stops. You now have the potential for having an excess low for the day. Now, this is where it gets tricky. Because of the downward range extension, I period no longer is exactly at half back. However, you have to remember that the I period is still weak because it was exactly at half back. You remember still that the AD highs are questionable, and remember that the B period high is questionable up there. So again, not easy. Nobody said trading is easy, but there are clues all day in this market. And it appears to me that the market is getting too short. All right, let's go ahead and play. We have an excess low, at least for now. Remember, we're playing it 20 times, an excess low. Excess is one of the two most important concepts we deal with. So it's going to be interesting to see what happens. Remember, I've been watching this market for a period of time, talking about the potential for it getting too short. Now, at the same time that I think the market's getting too short, notice value is almost 100% lower now. Mark the low of Friday's value, will you please, Jen? Would you put a red line across the low of Friday's value? Okay, notice value is now totally below Friday. So value as a filter, value is building lower today. Okay, stop again. K period high is also weak because one more time, it's exactly at half back. Watch these traders get in trouble. One more time, selling exactly at half back. So now we add up. We have questionable B period high, questionable A, D period high, questionable I period high, questionable K period high. Short-term traders are selling at constantly selling short at mechanical levels. The odds are that they continue to get themselves into trouble. As we get later in the session, short-term traders a lot of times have to flatten up before the day is over. All right, let's continue to play. Just watch traders getting them short all day long from very mechanical levels. At the same time, what is confusing, you say, well, Jim, but value is lower. It is. It is lower. So there's multiple things going on at any one time. That doesn't mean that short-term traders can't get themselves too short. Again, later in the session, they're continuing to sell the market. They have been selling the market all day long. Short-term traders have been selling the market short all day long. Remember, I've talked about slow trades and fast trades. Okay, L period is weak. Okay, you see now we've taken that out. We've taken out the L period high, the K period high. We still haven't taken out the AB period high. We're getting some short covering, and traders immediately, what are they doing? Selling again. They're selling all rallies today. Even though they got up there and they sold all that rally, still have a questionable AB period high, AD period high, and we still have a questionable B period high. Later, last session of the day, now we have an ADM period high, even weaker. Again, mechanically, traders were selling M period exactly at the opening. Continued, you see, they've been selling all day long. We get closer to the session, they're caught short. This is an extremely important educational day. These are the days that can be extremely costly if you don't understand what's going on. If you understand what's going on, you can trade as the short-term traders did, understanding what they're doing, but taking short-term profits and not staying around looking for these home runs. Okay, now the M period low is also weak because it's a single tick below half back. So even as we get late in the session and we're getting short covering, even late in the session, short covering, the market is still weak. Okay, now let's shift. We're closing, we're in the runoff session. The market failed to take the high. Value is overlapping to lower. So overall day is weak. At this point in time, on that rally, I had a position go on that, and I'd done some other things throughout the day, but on that short covering rally, I let my positions go because now the M period is questionable. It's a single tick below half back. The net for the day is that the market overall value is lower. Value is lower, and on this day, because value was lower, on this day, I went home short. I'm not trying to talk trades. I'm not trying to get you to do trades. I'm only trying to share my thinking. All right. It's been a very educational day. My suggestion is that you go through this day multiple times. This is an extremely important day to understand the behavior of short-term traders. It is rare that you will get a day that is isolated as today is. That's what makes it a very wonderful educational session. You see in isolation the behavior of these short-term traders at very short-term identifiable visual references. In most days, value will be overlapping to lower, overlapping to higher, and you will have a combination of short-term traders and other time frames. So it becomes more difficult, but knowing the characteristics of these short-term traders, it will start to help you filter out what is going on these days that are more overlapping to higher or lower. So again, thank you very much. I would suggest that you review this day multiple times.